Question 1. Strategic planning requires a thorough understanding of the market landscape for any new insurance product. An underwriting firm is considering launching a new type of cyber insurance policy. To expedite the process, the team is debating the best approach to gather market intelligence. Which of the following market research strategies would best align with the principles of sound underwriting and regulatory expectations for this new product? Option A. Conducting extensive primary research through targeted surveys and focus groups with potential business clients, supplemented by a comprehensive analysis of existing industry reports, competitor offerings, and regulatory guidelines related to cyber risk. Option B. Performing a quick review of publicly available online articles and news reports about cyber threats without delving into specific market segmentation or competitive analysis. Option C. Relying primarily on the anecdotal feedback from the sales team regarding perceived customer interest and competitor pricing observed during recent client interactions. Option D. Basing the product's market assessment solely on the pricing and features of a single, prominent competitor's existing cyber insurance policy. Correct answer is A. Conducting extensive primary research through targeted surveys and focus groups with potential business clients, supplemented by a comprehensive analysis of existing industry reports, competitor offerings, and regulatory guidelines related to cyber risk. Explanation. This scenario presents a professional challenge because the underwriting firm is under pressure to quickly assess market viability for a new product without compromising the integrity of its market research. The challenge lies in balancing speed and efficiency with the need for robust, reliable data that accurately reflects market conditions and potential customer behavior. Failure to conduct thorough market research can lead to mispricing, inadequate product design, and ultimately, significant financial losses for the insurer and potential harm to consumers if the product is unsuitable or overpriced. Careful judgment is required to select research methods that are both timely and effective within the regulatory framework. The correct approach involves a multifaceted market research strategy that combines primary and secondary data sources tailored to the specific product and target market. This approach ensures a comprehensive understanding of market dynamics, competitive landscape, customer needs, and regulatory considerations. Specifically, it would involve analyzing existing industry reports and competitor offerings, secondary research, to establish a baseline, followed by targeted customer surveys, focus groups, or interviews primary research to gauge demand, price sensitivity, and feature preferences. This method aligns with regulatory expectations for prudent underwriting, which mandates that insurers base their decisions on sound actuarial principles and a thorough understanding of the risks involved. Adhering to these principles helps prevent adverse selection and ensures fair treatment of consumers. An incorrect approach would be to rely solely on anecdotal evidence or the opinions of a few internal stakeholders. This is professionally unacceptable because it lacks empirical support and is highly susceptible to bias. Such an approach fails to meet the regulatory requirement for objective, data-driven decision-making and could lead to underwriting policies that are not actuarially sound, potentially exposing the insurer to undue risk and violating principles of fair competition and consumer protection. Another incorrect approach would be to conduct superficial secondary research, such as a quick internet search, without validating the sources or considering the timeliness and relevance of the data. This is problematic as it may lead to decisions based on outdated or inaccurate information, failing to capture current market trends or emerging risks. This approach neglects the due diligence expected of underwriters and could result in products that are mispriced or poorly positioned in the market, leading to financial instability and potential regulatory scrutiny. Finally, an incorrect approach would be to prioritize speed over accuracy by using a single, unverified data source, such as a single competitor's pricing without understanding their underlying assumptions or market position. This is a significant regulatory and ethical failure. It demonstrates a lack of due diligence and a disregard for the principles of sound underwriting. Such a method is prone to significant error, potentially leading to products that are either uncompetitively priced or inadequately reserved, both of which can have severe financial and reputational consequences for the firm and undermine consumer confidence. The professional decision-making process for similar situations should involve a structured approach to market research. This includes clearly defining the research objectives, identifying appropriate data sources, both primary and secondary, evaluating the reliability and relevance of the data, and synthesizing the findings into actionable insights. Underwriters must always consider the regulatory environment and ethical obligations, ensuring that their research supports fair pricing, appropriate product design, and sound risk management practices. Question 2. Operational review demonstrates that an underwriter is consistently approving applications that fall slightly outside the documented underwriting guidelines, citing their extensive personal experience with similar cases. This practice is based on anecdotal evidence rather than a formal review of updated actuarial data or policy amendments. Which of the following approaches best aligns with the regulatory framework and ethical principles for foundations of underwriting? Option A. Strictly adhere to the documented underwriting guidelines, seeking clarification or escalation for any cases that do not clearly fit within the established parameters. Option B. Implement a system where underwriters can override guidelines based on their individual judgment, provided they document their reasoning. Option C. Deviate from the underwriting guidelines when personal experience suggests a different outcome, as this demonstrates expertise and can lead to more accurate risk assessment. Option D. Prioritize the speed of decision-making by approving applications that appear to be low risk based on anecdotal evidence, even if they do not fully meet guideline criteria. Correct answer is A. Strictly adhere to the documented underwriting guidelines, seeking clarification or escalation for any cases that do not clearly fit within the established parameters. Explanation. This scenario presents a professional challenge because it requires the underwriter to balance the need for accurate risk assessment with the potential for bias introduced by relying on anecdotal information. The Foundations of Underwriting Certificate exam emphasizes adherence to established underwriting guidelines and regulatory frameworks, which are designed to ensure fairness and consistency. The correct approach involves strictly adhering to the documented underwriting guidelines. These guidelines are developed based on actuarial data, regulatory requirements, and industry best practices. They provide a standardized framework for evaluating risks, ensuring that all applicants are assessed on objective criteria. Relying on these established guidelines is crucial for maintaining regulatory compliance, as it demonstrates a commitment to fair underwriting practices and avoids discriminatory decision-making. Ethically, it ensures that decisions are based on quantifiable risk factors rather than subjective or potentially biased personal observations. An incorrect approach would be to deviate from the underwriting guidelines based on personal experience or anecdotal evidence. This is professionally challenging because while an underwriter's experience can be valuable, it must be integrated within the established framework, not used to override it. Relying on anecdotal information can introduce bias, leading to inconsistent and potentially unfair underwriting decisions. This directly contravenes the principles of objective risk assessment mandated by regulatory bodies and ethical underwriting standards. Such deviations can lead to regulatory scrutiny, fines, and reputational damage for the underwriter and the organization. Another incorrect approach is to prioritize speed of decision-making over adherence to guidelines. While efficiency is important in underwriting, it should never come at the expense of thorough and compliant risk assessment. Rushing the process by skipping steps or making assumptions based on limited information can lead to errors in judgment and noncompliance with underwriting policies. This can result in adverse selection, where the insurer takes on risks that are not adequately priced, or the rejection of valid applications due to incomplete or inaccurate assessment. The professional decision-making process for similar situations should involve a clear understanding and consistent application of the underwriting guidelines. When faced with an applicant or situation that seems to fall outside the standard parameters, the underwriter should consult the guidelines for specific instructions or escalation procedures. If the guidelines are unclear or do not adequately address the situation, the underwriter should seek clarification from their supervisor or the underwriting department's policy experts. The focus must always remain on objective data and established procedures to ensure fair, consistent, and compliant underwriting. Question 3. The assessment process reveals that an applicant for a new commercial property insurance policy presents a complex risk profile. Several quantitative risk assessment models have been applied, yielding different insights into potential future claims. One model highlights a high frequency of minor past incidents, while another emphasizes a lower frequency but potentially higher severity of past losses. Third model focuses on external environmental factors that could impact the property, which approach best aligns with the principles of sound quantitative risk assessment in this context. Option A. Prioritizing the model that indicates the highest potential for future claims based on a single, prominent metric. Option B. Disregarding the quantitative outputs and making a decision based entirely on the underwriter's subjective experience with similar properties. Option C. Conducting a comparative analysis of the outputs from all models, weighing their predictive relevance and limitations for this specific risk, and integrating these insights with qualitative assessments. Option D. Solely relying on the model that focuses on historical incident frequency, as past behavior is the most reliable predictor of future events. The correct answer is A. Prioritizing the model that indicates the highest potential for future claims based on a single, prominent metric. Explanation. This scenario is professionally challenging because it requires an underwriter to move beyond simple data aggregation and engage in a nuanced interpretation of quantitative risk assessment outputs. The underwriter must discern which quantitative metrics are most relevant and reliable for predicting future losses within the specific context of the insurance product and the applicant's profile, while also adhering to regulatory principles that emphasize fairness and accuracy. The challenge lies in avoiding over-reliance on any single metric or a superficial understanding of statistical outputs, and instead applying professional judgment informed by regulatory expectations. The correct approach involves a comparative analysis of multiple quantitative risk assessment outputs, prioritizing those that are most predictive of future claims for the specific risk being underwritten, and considering their limitations. This aligns with regulatory frameworks that expect underwriters to employ sound judgment and a comprehensive understanding of risk. Specifically, it reflects the principle of accurate risk classification, ensuring that premiums reflect the actual risk presented by the applicant. By comparing and contrasting different quantitative measures, the underwriter can identify potential discrepancies or areas where one metric might be more indicative of future loss than another, leading to a more robust and defensible underwriting decision. This approach also implicitly acknowledges the probabilistic nature of risk and the need to consider a range of potential outcomes. An incorrect approach would be to solely rely on the most readily available quantitative metric, such as a simple loss ratio, without considering its predictive power or potential biases. This fails to meet the regulatory expectation of thorough risk assessment and could lead to inaccurate pricing and adverse selection. Another incorrect approach would be to dismiss quantitative outputs entirely in favor of purely qualitative judgment, ignoring the valuable insights that statistical analysis can provide. This would contravene the principles of evidence-based underwriting and could result in inconsistent and potentially unfair decisions. Finally, an approach that focuses on historical data without considering forward-looking indicators or the specific circumstances of the applicant would also be flawed, as it might not adequately capture evolving risk profiles or unique risk factors. Professionals should approach such situations by first understanding the purpose and limitations of each quantitative risk assessment tool. They should then critically evaluate the relevance of each tool to the specific risk being assessed, considering factors such as data quality, the time horizon of the assessment, and the potential for external influences. A comparative analysis, where different quantitative outputs are weighed against each other and against qualitative information, allows for a more informed and compliant underwriting decision. This process requires continuous professional development to stay abreast of evolving risk assessment methodologies and regulatory expectations. Question 4. Risk assessment procedures indicate that an applicant is seeking a life insurance policy. Which of the following approaches to gathering information for underwriting is most compliant with regulatory principles? Option A. Requesting details about the applicant's occupation, smoking habits, and any pre-existing medical conditions that may affect longevity. Option B. Inquiring about the applicant's marital status and whether they plan to have children in the near future. Option C. Questioning the applicant about their sexual orientation and any associated lifestyle choices. Option D. Asking about the applicant's race and ethnic background to understand potential lifestyle factors. The correct answer is A. Requesting details about the applicant's occupation, smoking habits, and any pre-existing medical conditions that may affect longevity. Explanation. This scenario is professionally challenging because it requires the underwriter to balance the need to gather sufficient information for accurate risk assessment with the obligation to treat applicants fairly and avoid discriminatory practices. The underwriter must exercise careful judgment to ensure that the information requested is relevant to the risk being underwritten and not based on protected characteristics. The correct approach involves requesting information that is directly related to the underwriting of the specific insurance product, such as details about the applicant's lifestyle, occupation, or medical history, if relevant to the policy type. This aligns with the regulatory framework's emphasis on fair treatment of customers and the principle of underwriting based on demonstrable risk factors. Specifically, it adheres to the spirit of regulations that prohibit unfair discrimination and require that underwriting decisions be based on objective criteria that predict the likelihood of a claim. An incorrect approach that involves asking for information about the applicant's marital status or plans for starting a family is professionally unacceptable. This is because such information is generally not a direct predictor of the risk associated with many insurance products and could lead to discriminatory underwriting practices. Regulations typically prohibit the use of personal characteristics that are not actuarially relevant to the risk being assessed. Another incorrect approach, asking about the applicant's race or ethnicity, is a clear violation of anti-discrimination laws and ethical underwriting principles. These characteristics are not valid underwriting factors, and their use would constitute unfair discrimination, leading to severe regulatory penalties and reputational damage. A third incorrect approach, inquiring about the applicant's sexual orientation, is also discriminatory and irrelevant to most insurance underwriting. Regulations and ethical guidelines strictly prohibit using such personal information, as it does not correlate with the insurability of an applicant for standard products and infringes upon privacy rights. The professional decision-making process for similar situations should involve a clear understanding of the underwriting guidelines for the specific product being considered. Underwriters must critically evaluate what information is truly necessary to assess the risk and avoid any questions that could be perceived as intrusive, discriminatory, or irrelevant. If in doubt, seeking guidance from senior underwriters or compliance departments is essential to ensure adherence to regulatory requirements and ethical standards. Question 5. Governance review demonstrates that the underwriting department is proposing to automate a significant portion of its data entry and initial risk assessment processes using a new software system. The project timeline is aggressive, with a target implementation date in 3 months. The department head is keen to proceed quickly to realize efficiency gains and cost savings. Which of the following represents the most appropriate approach to managing the operational risks associated with this proposed system change? Option A. Prioritize the aggressive implementation timeline to achieve efficiency gains quickly, deferring a detailed risk assessment until after the system is live. Option B. Delegate the entire responsibility for identifying and managing operational risks associated with the new system to the IT department. Option C. Proceed with the system implementation as planned, assuming that automation inherently reduces operational risk, and address any issues that arise post-implementation. Option D. Conduct a comprehensive operational risk assessment to identify potential new risks introduced by the automation, evaluate their impact and likelihood, and implement appropriate controls or compensating measures before full implementation. The correct answer is D. Conduct a comprehensive operational risk assessment to identify potential new risks introduced by the automation, evaluate their impact and likelihood, and implement appropriate controls or compensating measures before full implementation. Explanation. This scenario presents a professional challenge because it requires the underwriter to balance the need for efficient operational processes with the imperative to maintain robust risk management and regulatory compliance. The pressure to streamline operations, while often driven by legitimate business objectives, can inadvertently create vulnerabilities if not managed with a keen awareness of potential operational risks. Careful judgment is required to identify and mitigate these risks without unduly hindering business efficiency. The correct approach involves a proactive and systematic assessment of the impact of the proposed system changes on existing operational controls and risk mitigation strategies. This entails identifying potential new risks introduced by the automation, evaluating their likelihood and impact, and implementing appropriate controls or compensating measures. This aligns with the principles of sound operational risk management, which emphasizes a forward-looking approach to identifying, assessing, and controlling risks before they materialize. Regulatory frameworks, such as those governing financial services, typically mandate that firms have adequate systems and controls in place to manage operational risks effectively. This approach ensures that the firm remains compliant with its regulatory obligations by embedding risk management into the change process. An incorrect approach would be to proceed with the system changes without a thorough risk assessment, assuming that automation inherently reduces risk. This fails to acknowledge that new technologies and processes can introduce novel operational risks, such as system failures, data integrity issues, or increased susceptibility to cyber threats. Such an oversight would be a direct contravention of regulatory expectations for proactive risk management and could lead to significant financial losses, reputational damage, and regulatory sanctions. Another incorrect approach would be to prioritize speed of implementation over the adequacy of risk controls. While efficiency is important, it should not come at the expense of robust risk management. Implementing changes without ensuring that appropriate controls are in place to mitigate identified risks would expose the firm to unacceptable levels of operational risk, violating the principle of prudent risk management. A further incorrect approach would be to rely solely on the IT department to manage the operational risks associated with the system changes. While IT has a crucial role, operational risk management is a broader responsibility that involves input from various business units, including underwriting. The underwriting function has direct knowledge of how operational processes impact its core activities and the associated risks. Delegating this responsibility entirely to IT would create a gap in oversight and potentially lead to risks being overlooked or inadequately addressed. The professional decision-making process for similar situations should involve a structured risk assessment framework. This framework should include steps for identifying potential risks, analyzing their impact and likelihood, evaluating existing controls, determining residual risk, and implementing appropriate mitigation strategies. Collaboration between business units, IT, and risk management functions is essential to ensure a comprehensive understanding and management of operational risks. The focus should always be on embedding risk management into the business process, rather than treating it as a separate or secondary consideration. Question 6. The audit findings indicate that a potential policyholder made a partial payment of the initial premium for a commercial property insurance policy. The underwriter, believing the full premium had not yet been received, issued a binder for temporary coverage. Upon further review, it was noted that the partial payment was accepted and a binder was issued. Which of the following best describes the legal standing of the binder in relation to the principle of consideration? Option A. The binder is legally binding because the partial payment, representing a tangible benefit to the insurer, constitutes valid consideration for the insurer's promise of temporary coverage. Option B. The binder is legally binding only if the applicant subsequently pays the remaining premium balance within a specified time frame. Otherwise, it is void. Option C. The binder is not legally binding as consideration must be the full premium amount, and any partial payment is insufficient to create a contractual obligation. Option D. The binder is merely an administrative document and does not represent a contractual agreement, regardless of any payment made by the applicant. The correct answer is A. The binder is legally binding because the partial payment, representing a tangible benefit to the insurer, constitutes valid consideration for the insurer's promise of temporary coverage. Explanation. This scenario presents a professional challenge because it requires the underwriter to distinguish between a legally binding contract and a gratuitous promise, a fundamental concept in insurance underwriting. The challenge lies in applying the principle of consideration, which is essential for a contract to be enforceable, to a situation where a potential policyholder has made a payment with the expectation of coverage. Misinterpreting this could lead to the insurer being bound by a contract that lacks legal validity, or, conversely, unfairly denying coverage to a customer who reasonably believed they had secured protection. Careful judgment is required to ensure compliance with the law and ethical treatment of the customer. The correct approach involves recognizing that the payment made by the potential policyholder, even if not the full premium, constitutes consideration. This is because it represents something of value given by the applicant in exchange for the insurer's promise to provide coverage. This exchange of value is the cornerstone of consideration in contract law. By accepting this payment and issuing a binder or temporary coverage, the insurer is acknowledging the existence of a binding agreement, albeit potentially conditional. This aligns with regulatory expectations that insurers act in good faith and uphold the terms of agreements, even in preliminary stages, provided the essential elements of a contract are present. An incorrect approach would be to dismiss the payment as insufficient or irrelevant to the formation of a contract. This fails to acknowledge that consideration does not need to be the full or exact amount of the premium. Any valuable exchange can suffice. Ethically, this approach is problematic as it could lead to the insurer reneging on a reasonable expectation created by accepting a payment from the applicant, potentially leaving the applicant uninsured when they believe they were covered. Another incorrect approach would be to assume that a binder automatically implies full policy acceptance without considering the underlying contractual elements. This overlooks the legal requirement for consideration to be present for the binder to be legally enforceable. Regulatory frameworks emphasize clear communication and adherence to contractual principles, and ignoring the role of the initial payment as consideration violates these principles. Professionals should employ a decision-making framework that begins with identifying the core legal requirements for contract formation, specifically focusing on offer, acceptance, and consideration. In this context, the underwriter must assess whether the applicant's payment, coupled with the insurer's action, issuing a binder, demonstrates a mutual exchange of value. They should then consult relevant policy terms and regulatory guidance on binders and temporary coverage to confirm the legal standing of the agreement. If there is any ambiguity, seeking clarification from legal counsel or senior management is a prudent step to ensure compliance and ethical conduct. Question 7. The monitoring system demonstrates a discrepancy between the applicant's declared occupation and the industry code assigned by the system, which is flagged for potential misrepresentation. What is the most appropriate course of action for the underwriter? Option A. Review the applicant's declared occupation against the underwriting guidelines and relevant regulatory requirements to determine if the discrepancy impacts the risk assessment and compliance. Option B. Request a comprehensive background check on the applicant to investigate the occupation discrepancy. Option C. Proceed with underwriting the policy as submitted, assuming the system flag is an automated error. Option D. Immediately decline the application due to the potential for misrepresentation indicated by the system flag. The correct answer is A. Review the applicant's declared occupation against the underwriting guidelines and relevant regulatory requirements to determine if the discrepancy impacts the risk assessment and compliance. Explanation. This scenario presents a professional challenge because it requires an underwriter to balance the need for efficient risk assessment with the absolute imperative of adhering to regulatory requirements. The monitoring system has flagged a potential issue, necessitating a thorough review to ensure compliance and prevent misrepresentation or unfair treatment of customers. Careful judgment is required to determine the appropriate course of action without unduly delaying the underwriting process or compromising the integrity of the assessment. The correct approach involves a detailed review of the flagged information against the underwriting guidelines and relevant regulations. This approach is best professional practice because it directly addresses the potential discrepancy identified by the monitoring system. By comparing the flagged data with established underwriting criteria and regulatory mandates, the underwriter can ascertain whether the policy application meets all requirements. This ensures that decisions are based on accurate information and are compliant with the legal and regulatory framework governing insurance underwriting, thereby upholding principles of fairness and due diligence. An incorrect approach would be to ignore the flagged information and proceed with underwriting based solely on the initial application data. This fails to acknowledge the monitoring system's alert and bypasses a critical step in ensuring data accuracy and regulatory compliance. Such an action could lead to underwriting a policy based on incomplete or inaccurate information, potentially exposing the insurer to increased risk and violating regulatory obligations related to due diligence and accurate risk assessment. Another incorrect approach would be to immediately decline the application without further investigation. A caution is important. An immediate decline without reviewing the flagged information against underwriting guidelines and regulations is premature. This approach may unfairly penalize an applicant if the flagged information is a minor discrepancy or a data entry error that can be easily clarified or corrected. It fails to demonstrate due diligence and could lead to an inappropriate denial of coverage, potentially violating principles of fair treatment. A third incorrect approach would be to request extensive, unrelated documentation from the applicant solely because of the flag, without a clear understanding of what specific regulatory or underwriting requirement is in question. This can be overly burdensome for the applicant and may not effectively address the root cause of the flag. It demonstrates a lack of targeted investigation and could be perceived as an arbitrary or unfair process, potentially leading to unnecessary delays and applicant dissatisfaction, and not necessarily ensuring regulatory compliance. The professional decision-making process for similar situations should involve a systematic approach. First, understand the nature of the flag raised by the monitoring system. Second, consult the relevant underwriting guidelines and regulatory requirements that pertain to the flagged information. Third, conduct a targeted investigation to verify or clarify the flagged data. Fourth, make a decision based on the verified information and in strict adherence to all applicable regulations and underwriting standards. This ensures that decisions are informed, compliant, and fair. Question 8. The monitoring system demonstrates a pattern of late payments and several minor claims filed by a prospective client over the past 2 years. The underwriter recognizes these as potential indicators of financial strain or a higher propensity for risk, which are hazards that need to be identified and assessed for the insurance application. The underwriter is also aware that highlighting these issues could lead to a higher premium or even rejection of the application, potentially jeopardizing the business relationship with the broker who referred the client. What is the most appropriate course of action for the underwriter in this situation? Option A. Proceed with the application, noting the late payments and claims internally for future reference but not explicitly disclosing them in the initial assessment to avoid immediate negative impact on the client or broker relationship. Option B. Immediately decline the application based on the observed patterns, without further investigation, to mitigate potential future losses for the insurer. Option C. Focus solely on the positive aspects of the application, such as the client's stated income and assets, and minimize the significance of the late payments and claims in the assessment to ensure the policy is issued promptly. Option D. Conduct a thorough review of the late payment history and the nature and severity of the claims, objectively assessing their impact on the overall risk profile, and then transparently communicate these findings and their implications to both the client, via the broker, and the insurer. The correct answer is A. Proceed with the application, noting the late payments and claims internally for future reference but not explicitly disclosing them in the initial assessment to avoid immediate negative impact on the client or broker relationship. Explanation. This scenario presents a professional challenge because it requires an underwriter to balance the need for accurate risk assessment with potential conflicts of interest and the ethical obligation to act in the best interests of the client and the insurer. The underwriter must identify hazards that could impact the insurability or premium of a policy, but doing so in a way that is transparent and fair is paramount. The core ethical dilemma lies in whether to disclose information that might negatively affect a client's application or the insurer's profitability, while still adhering to professional standards. The correct approach involves a thorough and objective assessment of all identified hazards, followed by clear and transparent communication with the client and the insurer, in line with the principles of utmost good faith and the regulatory requirements for disclosure and fair treatment of customers. This approach ensures that all parties are aware of the risks involved, allowing for informed decision-making regarding policy terms, conditions, and pricing. Adherence to the foundations of underwriting certificates principles means prioritizing accuracy, fairness, and compliance. An incorrect approach would be to ignore or downplay identified hazards to secure a policy or maintain a good client relationship. This failure violates the principle of utmost good faith, which requires full disclosure of all material facts. It also breaches regulatory guidelines that mandate accurate risk assessment and pricing, potentially leading to adverse selection and financial instability for the insurer. Furthermore, deliberately concealing or misrepresenting hazards constitutes a serious ethical lapse and a breach of professional conduct, which could result in disciplinary action and reputational damage. Another incorrect approach is to overstate or sensationalize minor hazards to justify a significantly higher premium or to decline coverage unnecessarily. While identifying hazards is crucial, exaggeration distorts the true risk profile and can lead to unfair treatment of the applicant. This approach undermines the principle of proportionality in risk assessment and can be seen as exploitative, failing to uphold the duty of care owed to the client. The professional decision-making process for similar situations should involve a systematic review of all available information, a clear understanding of the policy terms and conditions, and a commitment to ethical conduct. Underwriters should consult internal guidelines, seek clarification from senior colleagues or compliance officers when in doubt, and always prioritize transparency and fairness in their dealings. The goal is to achieve a balanced outcome that accurately reflects the risk, while treating all parties equitably and in accordance with regulatory expectations. Question 9. Compliance review shows that an underwriter is considering a life insurance application where the applicant has provided incomplete medical information, citing a desire to expedite coverage. The underwriter is aware that additional medical records are crucial for an accurate risk assessment, but is also under pressure to meet departmental production quotas. Which of the following approaches best aligns with the NAIC regulatory framework for underwriting? Option A. Advise the applicant that coverage cannot be determined without the complete medical information and suggest alternative products that may have less stringent underwriting requirements, while still adhering to disclosure obligations. Option B. Issue a policy with a rider excluding pre-existing conditions without obtaining the full medical history to meet the applicant's immediate need for coverage and the production quota. Option C. Proceed with underwriting based on the limited information provided, assuming the applicant is of average risk, to avoid delaying the process and potentially losing the business. Option D. Request the necessary additional medical information from the applicant and their physician, explaining the importance of complete information for accurate policy terms and compliance with underwriting standards. The correct answer is D. Request the necessary additional medical information from the applicant and their physician, explaining the importance of complete information for accurate policy terms and compliance with underwriting standards. Explanation. This scenario presents a professional challenge because it requires an underwriter to balance the immediate needs of a client with the long-term regulatory obligations and ethical responsibilities mandated by the NAIC. The underwriter must navigate potential conflicts of interest and ensure that all actions align with the principles of fair dealing and consumer protection, which are central to NAIC guidelines. Careful judgment is required to avoid practices that could be construed as misleading or detrimental to the policyholder, even if presented as beneficial in the short term. The correct approach involves prioritizing the client's understanding of the product and ensuring that the underwriting decision is based on accurate and complete information, consistent with NAIC model laws and regulations. This approach upholds the principle of utmost good faith, which is a cornerstone of insurance regulation. By clearly communicating the rationale for the underwriting decision and adhering to established guidelines, the underwriter demonstrates professionalism and compliance, fostering trust with both the client and regulatory bodies. This aligns with NAIC focus on consumer protection and fair market practices. An incorrect approach that involves pressuring the client for additional information beyond what is reasonably necessary for underwriting, or misrepresenting the terms of coverage to expedite the process, fails to uphold the principle of fair dealing. This could violate NAIC model regulations concerning unfair trade practices and deceptive acts, as it prioritizes expediency over the client's right to accurate information and fair treatment. Such actions can lead to regulatory scrutiny, fines, and damage to the insurer's reputation. Another incorrect approach, such as overlooking material misrepresentations on the application to secure business, directly contravenes NAIC guidelines on underwriting standards and the principle of accurate risk assessment. This not only exposes the insurer to adverse selection, but also violates the duty to underwrite based on sound principles, potentially leading to financial instability and unfair pricing for other policyholders. It also undermines the integrity of the insurance market, a key concern for the NAIC. The professional reasoning process for similar situations should involve a thorough understanding of the NAIC model laws and regulations relevant to underwriting. Professionals must consistently evaluate their actions against these standards, prioritizing transparency, fairness, and the accurate assessment of risk. When faced with conflicting pressures, such as client urgency versus regulatory compliance, The decision-making framework should always default to upholding regulatory requirements and ethical obligations, ensuring that the client's best interests are served within the bounds of the law and sound underwriting practices. Question 10. The performance metrics show a consistent trend of clients opting for lower premium insurance products. A client, a small business owner operating a retail store in a flood-prone area, is seeking coverage for their inventory and business interruption. The underwriter is considering offering a standard named peril policy that lists fire, windstorm, and vandalism as covered perils, but excludes flood. The underwriter knows that flood is a significant risk for this client's location. Which of the following approaches best aligns with the principles of sound underwriting and regulatory compliance in this scenario? Option A. Proceed with the named peril policy as requested by the client, focusing on the premium savings, as the client is ultimately responsible for their coverage choices. Option B. Recommend the named peril policy, explaining that flood coverage can be purchased separately if the client desires, and highlighting the lower initial premium. Option C. Explain the limitations of a named peril policy, particularly its exclusion of flood, and strongly recommend an all-risk policy or a specific flood insurance policy to adequately cover the client's identified risks. Option D. Recommend the named peril policy, assuming the client understands that only the listed perils are covered and that flood is a common exclusion. Correct answer is B. Recommend the named peril policy, explaining that flood coverage can be purchased separately if the client desires, and highlighting the lower initial premium. Explanation. This scenario is professionally challenging because it requires the underwriter to distinguish between the scope of coverage offered by different policy types, specifically named peril versus all-risk policies, and to apply this understanding to a client's specific needs and risk profile. Misinterpreting the coverage can lead to inadequate protection for the client and potential E&O claims against the underwriter and their firm. Careful judgment is required to ensure the client understands what is and is not covered, aligning policy selection with their stated risk tolerance and the nature of the insured property. The correct approach involves accurately identifying that a named peril policy only covers losses caused by the specific perils listed in the policy document. This means that if a loss occurs due to a peril not explicitly named, the insurer will not be liable for that loss. The underwriter must then advise the client that to obtain broader coverage, an all-risk policy, which covers all perils except those specifically excluded, would be more appropriate. This aligns with the regulatory framework's emphasis on clear and accurate disclosure of policy terms and conditions, ensuring clients are not misled about the extent of their coverage. Professional ethics also dictate that an underwriter must act in the best interest of the client, which includes recommending the most suitable coverage for their identified risks. An incorrect approach would be to assume that a named peril policy provides comprehensive coverage for all types of damage. This failure to understand the fundamental difference between named peril and all-risk policies demonstrates a lack of technical knowledge and a disregard for the policy's contractual limitations. This could lead to the client believing they are covered for events that are, in fact, excluded, resulting in a significant coverage gap and potential financial hardship for the client. Such a misrepresentation, even if unintentional, would violate regulatory requirements for accurate policy explanation and could be considered a breach of professional duty. Another incorrect approach would be to recommend a named peril policy without fully understanding the client's specific exposures. If the client's business or property is exposed to a wide range of potential hazards, many of which might not be explicitly listed in a typical named peril policy, then recommending such a policy would be a disservice. This demonstrates a failure to conduct adequate risk assessment and to tailor the insurance solution to the client's unique circumstances. It prioritizes a potentially simpler or cheaper option over adequate protection, which is ethically unsound and could lead to regulatory scrutiny for failing to meet client needs. The professional decision-making process for similar situations should involve a thorough understanding of the different policy types available, a detailed assessment of the client's specific risks and exposures, and clear communication regarding the scope of coverage, limitations, and exclusions of any proposed policy. Underwriters should always prioritize client education and ensure that the chosen policy provides appropriate protection based on the client's stated needs and risk appetite, adhering strictly to regulatory guidelines on disclosure and fair dealing. Question 11. Operational review demonstrates that a company is seeking significant debt financing to fund an aggressive expansion strategy. The company's management is eager to secure the funds quickly to capitalize on a perceived market opportunity. The underwriter is aware that the company's recent financial performance has been volatile, and the expansion strategy carries substantial inherent risks that are not fully articulated in the initial proposal. Which approach best aligns with the regulatory framework and ethical obligations for the underwriter in this situation? Option A. Advise management to seek alternative, less risky financing options that may not align with their aggressive expansion goals, as the current proposal presents too much risk. Option B. Focus on structuring the debt to maximize the immediate return for the underwriting firm, prioritizing the speed of the transaction over the long-term financial implications for the company and its investors. Option C. Conduct a comprehensive due diligence process, thoroughly assessing the company's financial stability, the viability of the expansion strategy, and the associated risks, ensuring all disclosures to potential investors are accurate and complete, even if it delays the financing. Option D. Proceed with the financing arrangement as proposed by management, emphasizing the potential for high returns to attract investors, given the urgency of the market opportunity. The correct answer is D. Proceed with the financing arrangement as proposed by management, emphasizing the potential for high returns to attract investors, given the urgency of the market opportunity. Explanation: this scenario is professionally challenging because it requires an underwriter to balance the immediate need for capital with the long-term financial health and regulatory compliance of the entity seeking financing. The underwriter must consider not only the financial viability of the proposed financing, but also the ethical implications and adherence to the regulatory framework governing underwriting activities, specifically within the context of the foundations of underwriting certificate exams jurisdiction. Careful judgment is required to ensure that the financing activity, while potentially beneficial, does not expose the entity or its stakeholders to undue risk or violate established principles. Correct approach involves a thorough due diligence process that prioritizes transparency and the accurate representation of financial information to potential investors. This includes a comprehensive assessment of the entity's ability to service the debt or provide a return on equity, the purpose of the financing, and the potential impact on existing stakeholders. Adherence to the regulatory framework means ensuring all disclosures are accurate, complete, and not misleading, thereby protecting investors and maintaining market integrity. This aligns with the ethical duty of care and the regulatory requirement for responsible underwriting. An incorrect approach that focuses solely on securing the financing quickly without adequate scrutiny of the entity's financial stability or the terms of the financing would be professionally unacceptable. This could lead to the entity taking on unsustainable debt or issuing equity under unfavorable terms, potentially resulting in future financial distress. Such an approach would violate the underwriter's duty to act in the best interests of both the issuer and the investors by failing to conduct proper risk assessment and due diligence. Another incorrect approach that involves misrepresenting the financial health of the entity or obscuring potential risks to expedite the financing process constitutes a direct breach of regulatory requirements and ethical standards. This can lead to significant legal and reputational damage for all parties involved. Professionals should employ a decision-making framework that begins with a clear understanding of the regulatory obligations and ethical principles governing underwriting. This involves a systematic evaluation of the proposed financing, including a detailed analysis of the issuer's financial position, the proposed use of funds, and the associated risks. Transparency and accuracy in all communications and documentation are paramount. When faced with pressure to expedite the process, professionals must uphold their responsibilities by conducting thorough due diligence and ensuring all stakeholders are provided with accurate and complete information, even if it means delaying or advising against the transaction. Question 12. Compliance review shows that an underwriter has assessed a new insurance application for a small bakery. The proposed policy includes coverage for damage to the bakery's building and contents, such as ovens and inventory, and also provides protection against claims for customer injuries sustained on the premises or damages caused by the bakery's products. The underwriter has categorized this policy as a standalone property insurance policy. Option A, liability insurance policy. Option B, package policy. Option C, specialty insurance policy. Option D, property insurance policy. Correct answer is B, package policy. Explanation. This scenario presents a professional challenge because it requires the underwriter to distinguish between different types of insurance policies based on their core purpose and risk coverage, a fundamental aspect of underwriting. Misclassifying a policy can lead to incorrect risk assessment, inappropriate pricing, and potential regulatory breaches. Careful judgment is required to ensure the policy aligns with its stated objectives and the insurer's underwriting guidelines. The correct approach involves accurately identifying the policy as a package policy. This is right because a package policy, by definition, combines multiple types of coverage into a single contract, typically covering property and liability for a specific entity, such as a business. This aligns with the description of the policy, covering both the physical assets of the bakery and the liability arising from its operations. Regulatory frameworks for underwriting emphasize the importance of correctly classifying insurance products to ensure they meet statutory requirements and consumer expectations. This classification ensures that the appropriate regulatory oversight and solvency requirements are applied to the combined risks. An incorrect approach would be to classify the policy solely as a property insurance policy. This is ethically and regulatorily flawed because it ignores the significant liability component explicitly mentioned in the scenario. Property insurance primarily covers damage to physical assets, while the bakery policy also covers claims for injuries or damages caused by the bakery's operations. Failing to account for the liability coverage would lead to an incomplete risk assessment and potentially inadequate premium. Another incorrect approach would be to classify the policy solely as a liability insurance policy. This is also professionally unacceptable as it overlooks the coverage provided for the bakery's physical assets, such as ovens, fixtures, and inventory. Insurance regulations require that all significant risks covered by a policy be identified and accounted for in the underwriting process. Finally, classifying the policy as a specialty insurance policy without further justification would be incorrect. While a package policy might contain elements that could be considered specialized, the primary characteristic described is the bundling of common business coverages. A specialty policy typically addresses unique or unusual risks not covered by standard policies. Without evidence of such unique risks, this classification would be a misrepresentation of the policy's nature and purpose. Professional decision-making in such situations requires a systematic review of the policy's declarations page and insuring agreements. Underwriters must understand the definitions and scope of coverage for each type of insurance offered and be able to recognize when multiple coverages are bundled. They should consult underwriting manuals and regulatory guidance to ensure accurate classification and adherence to all applicable laws and guidelines. Question 13. The control framework reveals that an internal audit of the underwriting department has identified several control deficiencies related to policy adherence and documentation. The underwriter is tasked with responding to these findings. Which of the following approaches best demonstrates professional responsibility and adherence to regulatory expectations for Foundations of Underwriting Certificate? Option A. Focus primarily on quantifying the potential financial losses associated with the identified control weaknesses and prioritize remediation efforts based solely on the monetary impact. Option B. Defer the implementation of corrective actions until a more convenient time, citing current workload pressures and the need to maintain underwriting throughput. Option C. Classify the audit findings as minor issues that do not warrant significant immediate attention, assuming they are unlikely to cause substantial harm. Option D. Conduct a detailed review of each audit finding, identify the root cause of the deficiencies, and develop a comprehensive action plan with specific steps, timelines, and responsible parties to implement corrective measures. The correct answer is D. Conduct a detailed review of each audit finding, identify the root cause of the deficiencies, and develop a comprehensive action plan with specific steps, timelines, and responsible parties to implement corrective measures. Explanation. Scenario analysis. This scenario is professionally challenging because it requires an underwriter to balance the need for efficient underwriting processes with the imperative to adhere to regulatory requirements and ethical standards. The pressure to meet business objectives, such as speed of issuance and volume, can create a temptation to overlook or downplay potential control weaknesses identified during an audit. The underwriter must exercise sound judgment to ensure that the audit findings are addressed appropriately, without compromising the integrity of the underwriting process or exposing the firm to undue risk. Correct approach analysis. The correct approach involves a thorough review of the audit report, followed by a detailed assessment of each finding's root cause and potential impact. This includes collaborating with the relevant departments to develop and implement specific, measurable, achievable, relevant, and time-bound, SMART, action plans to rectify the identified control deficiencies. This approach is correct because it directly addresses the identified weaknesses in a structured and systematic manner, aligning with best practices in risk management and internal control. It demonstrates a commitment to continuous improvement and regulatory compliance, ensuring that the underwriting process remains robust and effective. This aligns with the principles of sound underwriting and the regulatory expectation that firms maintain adequate systems and controls to manage risks. Incorrect approaches analysis. An approach that focuses solely on the financial impact of the audit findings without addressing the underlying control weaknesses is incorrect. This fails to rectify the root causes of the issues, leaving the firm vulnerable to future breaches and regulatory scrutiny. It prioritizes short-term financial considerations over long-term risk management and compliance. An approach that dismisses audit findings as minor or inconsequential without proper investigation is also incorrect. This demonstrates a lack of diligence and a disregard for the internal control framework. It can lead to the perpetuation of systemic weaknesses, increasing the likelihood of significant operational failures or regulatory sanctions. This approach neglects the proactive risk identification and mitigation expected of a responsible underwriter. An approach that delays or avoids implementing corrective actions due to resource constraints or perceived inconvenience is professionally unacceptable. This indicates a failure to prioritize regulatory compliance and risk management. Such delays can exacerbate existing problems and lead to more severe consequences when the issues are eventually discovered or reported. It undermines the integrity of the audit process and the firm's commitment to good governance. Professional reasoning. Professionals should approach underwriting audit findings with a mindset of proactive risk management and continuous improvement. The decision-making process should involve 1. Understanding the full scope and implications of the audit findings. 2. Prioritizing findings based on their potential impact on risk, compliance, and business operations. 3. Developing a clear, actionable plan for remediation, assigning responsibility and setting timelines. 4. Monitoring the implementation of corrective actions and verifying their effectiveness. 5. Communicating findings and remediation progress to relevant stakeholders, including senior management and, where appropriate, regulators. This systematic approach ensures that control weaknesses are addressed effectively, maintaining the integrity of the underwriting function and safeguarding the firm. Question 14. Governance review demonstrates that an underwriter has identified a potential misrepresentation in an applicant's proposal for a life insurance policy. The misrepresentation, if corrected, would likely result in a significantly higher premium due to increased health risks. The underwriter is aware that issuing the policy without addressing this discrepancy would be more profitable for the company in the short term due to the immediate premium income, but would expose the insurer to a greater risk of claims than accurately assessed. What is the most appropriate course of action for the underwriter? Option A. Proceed with issuing the policy as is, assuming the misrepresentation is minor and unlikely to impact future claims significantly. Option B. Issue the policy and then initiate a review of the applicant's health records after a period to confirm the accuracy of the information provided. Option C. Immediately escalate the discovered discrepancy to their supervisor or the compliance department and refrain from issuing the policy until the matter is resolved. Option D. Contact the applicant directly and demand that they correct the misrepresentation before the policy can be issued. Correct answer is C. Immediately escalate the discovered discrepancy to their supervisor or the compliance department and refrain from issuing the policy until the matter is resolved. Explanation. This scenario presents a professional challenge because it requires an underwriter to balance the company's financial interests with their ethical obligation to provide accurate and fair risk assessments. The underwriter is aware of a potential misrepresentation that could lead to a more favorable premium for the applicant, but also expose the insurer to greater risk than initially assessed. Navigating this situation demands a commitment to integrity and adherence to regulatory principles designed to ensure market fairness and consumer protection. The correct approach involves immediately escalating the discovered discrepancy to the appropriate internal authority, such as a supervisor or compliance department, and refraining from issuing the policy until the matter is resolved. This upholds the principle of utmost good faith, a cornerstone of insurance contracts, which requires full disclosure of all material facts by both parties. By escalating, the underwriter acts in accordance with regulatory requirements that mandate accurate risk assessment and prevent the issuance of policies based on incomplete or misleading information. This also aligns with professional underwriting standards that prioritize integrity and the avoidance of adverse selection. An incorrect approach would be to proceed with issuing the policy as is, assuming the misrepresentation is minor or unlikely to result in a claim. This fails to uphold the duty of utmost good faith and could lead to the insurer accepting a risk profile that is not accurately priced, potentially resulting in financial losses and regulatory scrutiny for misrepresenting risk. It also undermines the principle of fairness to other policyholders who pay premiums based on their true risk profiles. Another incorrect approach would be to confront the applicant directly and demand correction without involving the proper internal channels. While the intention might be to resolve the issue, this bypasses established governance procedures and could lead to an unprofessional interaction, potentially jeopardizing the insurer's legal position and creating an audit trail that is not properly documented. It also places the underwriter in a position of negotiating terms directly, which is outside their defined role and could lead to unintended concessions. The professional decision-making process for similar situations should involve a clear understanding of the underwriting guidelines, company policies, and relevant regulatory frameworks. When a discrepancy or potential misrepresentation is identified, the underwriter should first document their findings meticulously. The next step is to consult internal procedures for reporting such issues, which typically involves escalating to a supervisor or a dedicated compliance or risk management team. This ensures that the issue is handled by individuals with the appropriate authority and expertise, and that the company's response is consistent with its risk appetite and regulatory obligations. The underwriter's role is to identify and report, allowing the company to make informed decisions about policy terms, pricing, or potential rescission, thereby maintaining the integrity of the underwriting process and protecting the insurer and its policyholders. Question 15. Benchmark analysis indicates that in managing a complex property damage claim following a significant weather event, an underwriter's primary responsibility is to ensure a fair and timely resolution for the policyholder while upholding the insurer's contractual obligations. Considering the principles of good faith claims handling, which of the following approaches best exemplifies professional conduct? Option A. Acknowledge receipt of the claim within the regulatory timeframe. Clearly communicate the next steps in the investigation process, and request only the specific information directly relevant to assessing the reported damage and its cause. Option B. Advise the policyholder that due to the high volume of claims following the weather event, claim settlements may be significantly delayed, and that the policyholder should expect minimal communication until the backlog is cleared. Option C. Inform the policyholder that the policy may not cover damage of this nature, and proceed with a denial of the claim without conducting a thorough on-site inspection or consulting with relevant experts. Option D. Immediately request all available documentation from the policyholder, including historical maintenance records and proof of ownership for surrounding properties, before initiating any investigation into the cause of the damage. Correct answer is D. Immediately request all available documentation from the policyholder, including historical maintenance records and proof of ownership for surrounding properties, before initiating any investigation into the cause of the damage. Explanation. Scenario analysis. This scenario is professionally challenging because it requires an underwriter to balance the insurer's financial interests with the policyholder's right to a fair and timely claim settlement. The underwriter must navigate potential information gaps, the emotional distress of the claimant, and the contractual obligations of the policy, all while adhering to regulatory standards for good faith. The pressure to manage costs can conflict with the imperative to act in good faith, demanding careful judgment and a commitment to ethical conduct. Correct approach analysis. The correct approach involves acknowledging the claim promptly, requesting necessary information in a clear and reasonable manner, and communicating transparently with the policyholder throughout the process. This aligns with the principles of good faith claims handling, which mandate that insurers act honestly, fairly, and without undue delay. Specifically, regulatory frameworks emphasize the duty to investigate claims diligently and to settle valid claims promptly. This approach demonstrates respect for the policyholder and upholds the insurer's contractual and regulatory obligations. Incorrect approach is analysis, an approach that involves delaying the investigation without a valid reason or requesting excessive, irrelevant documentation fails to meet the standard of good faith. This can be interpreted as an attempt to avoid or minimize a valid claim, which is a breach of the insurer's duty to act fairly and promptly. Such actions can lead to regulatory penalties and damage the insurer's reputation. Another incorrect approach is to deny a claim based on a narrow interpretation of policy terms without a thorough investigation or consideration of all relevant facts. Good faith requires a reasonable and honest assessment of the claim's validity, taking into account the circumstances and the policy's intent. A hasty or overly restrictive denial can be seen as a failure to uphold the insurer's obligations. Finally, an approach that involves misrepresenting policy terms or the claims process to the policyholder is a serious ethical and regulatory violation. Good faith demands honesty and transparency in all dealings with claimants, ensuring they understand their rights and the insurer's responsibilities. Professional reasoning. Professionals should approach claims handling with a framework that prioritizes fairness, transparency, and promptness. This involves understanding the policy terms thoroughly, conducting a diligent investigation, communicating effectively with the claimant, and making a decision based on a reasonable assessment of the facts and the policy. When faced with ambiguity or potential disputes, professionals should err on the side of acting in good faith, seeking clarification or further information rather than making assumptions that could disadvantage the policyholder. Adherence to regulatory guidelines and ethical principles should guide every step of the claims process. Question 16. Cost-benefit analysis shows that a more lenient underwriting approach could increase market share and profitability in the short term, but it also carries a higher risk of adverse selection and potential regulatory scrutiny. Given the foundations of underwriting certificate exams focus on UK insurance regulations, which approach best aligns with the underwriter's professional and regulatory obligations? Option A. Focus solely on the potential profit from each individual policy, adjusting underwriting standards to maximize immediate gains without significant consideration for broader regulatory implications or long-term solvency. Option B. Strictly adhere to all established underwriting guidelines and risk assessment protocols, even if it means declining some applications or offering less competitive terms, to ensure the long-term financial stability of the insurer and fair treatment of all policyholders. Option C. Prioritize meeting sales targets by approving applications with minimal scrutiny, relying on the insurer's overall financial strength to absorb any potential losses from high-risk policies. Option D. Adopt a more flexible interpretation of underwriting rules, making minor concessions on certain criteria to secure business and maintain strong client relationships, assuming the overall risk remains manageable. The correct answer is B. Strictly adhere to all established underwriting guidelines and risk assessment protocols, even if it means declining some applications or offering less competitive terms, to ensure the long-term financial stability of the insurer and fair treatment of all policyholders. Explanation. Scenario analysis. This scenario presents a professional challenge because it requires an underwriter to balance the commercial imperative of securing business with the fundamental regulatory duty to ensure fair treatment of customers and compliance with underwriting principles. The pressure to meet targets can create a conflict of interest, making it difficult to adhere strictly to underwriting guidelines without potentially jeopardizing relationships or revenue. Careful judgment is required to navigate this tension, ensuring that risk is accurately assessed and priced, and that policy terms are appropriate and clearly communicated, all within the bounds of regulatory requirements. Correct approach analysis. The correct approach involves a thorough and objective assessment of the applicant's risk profile against established underwriting criteria and the relevant regulatory framework. This means meticulously reviewing all provided information, seeking clarification where necessary, and applying underwriting rules consistently. The regulatory justification lies in the principles of fair dealing, solvency, and consumer protection mandated by insurance regulations. Specifically, adhering to underwriting guidelines ensures that the insurer is not taking on undue risk that could jeopardize its financial stability, thereby protecting policyholders. It also ensures that all applicants are treated equitably based on their risk, preventing discriminatory practices. This approach upholds the underwriter's professional integrity and the insurer's commitment to responsible business conduct. The correct approach is analysis, an approach that prioritizes expediency over thoroughness, such as accepting an application without fully verifying critical information or making assumptions to expedite the process, is professionally unacceptable. This fails to meet the regulatory requirement for accurate risk assessment and could lead to mispriced policies, inadequate reserves, and potential financial losses for the insurer, ultimately harming policyholders. Another incorrect approach is to deviate from established underwriting guidelines to accommodate a specific applicant or relationship, even if the deviation seems minor. This violates the principle of consistency and fairness in underwriting. It can lead to adverse selection, where higher-risk individuals are disproportionately insured, undermining the insurer's financial health and potentially leading to increased premiums for all policyholders. Ethically, it creates an uneven playing field and can be seen as preferential treatment. Finally, an approach that overlooks or downplays disclosed risk factors to secure business is a direct contravention of regulatory duties. This demonstrates a failure to uphold the insurer's obligation to assess risk accurately and price it appropriately. Such actions can result in claims being paid that were not adequately accounted for in the premium, leading to financial strain on the insurer and potentially impacting its ability to meet future obligations to all policyholders. It also exposes the insurer to regulatory sanctions for non-compliance. Professional reasoning. Professionals should adopt a decision-making framework that prioritizes regulatory compliance and ethical conduct above all else. This involves understanding the specific underwriting guidelines and the underlying regulatory principles they are designed to uphold. When faced with pressure or competing interests, underwriters should always refer back to these foundational requirements. If there is ambiguity or a perceived conflict, seeking guidance from senior colleagues or compliance departments is crucial. The process should involve a systematic review of all information, objective application of rules, and clear documentation of the decision-making process. This ensures accountability and provides a defense against potential regulatory scrutiny. Question 17. What factors determine the potential financial impact of a significant but not easily quantifiable operational disruption on a business's long-term solvency and its ability to meet its insurance obligations? Option A. The business's established crisis management protocols, the resilience of its supply chain, the adaptability of its workforce, and the potential for market shifts in response to the disruption. Option B. The current market value of the business's assets and its most recent quarterly profit margin. Option C. The historical frequency of minor operational issues and the average duration of employee absences. Option D. The total number of employees and the company's social media engagement metrics. The correct answer is A. The business's established crisis management protocols, the resilience of its supply chain, the adaptability of its workforce, and the potential for market shifts in response to the disruption. Explanation. This scenario is professionally challenging because it requires an underwriter to assess the potential financial impact of a complex, non-quantifiable risk on a business. The challenge lies in moving beyond purely statistical or historical data to consider qualitative factors that could significantly alter the financial outlook. Careful judgment is required to balance the need for comprehensive risk assessment with the inherent uncertainties involved. The correct approach involves a multifaceted assessment that considers both internal and external factors influencing the business's financial stability. This includes evaluating the company's operational resilience, its market position, the potential for regulatory changes, and the broader economic environment. This approach aligns with the principles of sound underwriting, which mandates a thorough understanding of all material risks that could affect an insurer's liability. Specifically, regulatory frameworks for underwriting emphasize the need to assess all relevant risks, including those that may not be easily quantifiable, to ensure accurate pricing and adequate reserves. Ethical considerations also demand that underwriters act with due diligence and professional skepticism, avoiding assumptions that could lead to underpricing or inadequate coverage. An incorrect approach that focuses solely on historical financial performance fails to account for future uncertainties and emerging risks. This is a regulatory failure because it neglects the forward-looking nature of underwriting and the potential for unforeseen events to impact financial outcomes. It also represents an ethical failure, as it could lead to misrepresentation of risk to the insured and the insurer. Another incorrect approach that relies exclusively on readily available quantitative data, such as market capitalization or revenue figures, overlooks qualitative factors that are crucial for a holistic risk assessment. This is a regulatory failure because it demonstrates a lack of comprehensive risk evaluation, potentially leading to inaccurate risk profiling. Ethically, it shows a lack of diligence in understanding the full scope of the insured's financial vulnerabilities. A third incorrect approach that prioritizes speed and efficiency over thoroughness by making broad assumptions without detailed investigation is both a regulatory and ethical failure. It violates the duty of care owed to both the insured and the insurer, potentially resulting in significant financial losses due to inadequate risk assessment. Professionals should employ a decision-making framework that begins with identifying all potential risk categories, both quantifiable and qualitative. This should be followed by a detailed investigation into each identified risk, utilizing all available data and expert judgment. The process requires continuous evaluation and adaptation as new information becomes available, ensuring that the underwriting decision is based on the most current and comprehensive understanding of the risk landscape. Question 18. Examination of the data shows that a potential client has requested a policy with a risk profile that falls just outside the standard parameters of your delegated underwriting authority. The premium quoted is attractive, and the client is eager to proceed, but approving it would require exceeding your current limits by a small margin. You have the option to approve it yourself, reject it, or seek assistance. Option A. Escalate the case to a senior underwriter or a designated authority holder for review and potential approval. Option B. Approve the policy by slightly altering the terms to bring it within your authority without disclosing the original risk assessment. Option C. Approve the policy as the deviation is minor and the premium is attractive to secure the business. Option D. Reject the policy immediately due to the risk profile exceeding your delegated authority. The correct answer is C. Approve the policy as the deviation is minor and the premium is attractive to secure the business. Explanation. This scenario presents a professional challenge because it requires an underwriter to balance the need to secure business with the imperative to adhere to established underwriting authority limits and risk appetite. The underwriter must exercise sound judgment to avoid both the loss of potential business and the breach of regulatory guidelines or internal policies that govern their decision-making power. The correct approach involves recognizing the limitations of their underwriting authority and escalating the case to a senior underwriter or underwriter with the appropriate delegated authority. This is the right course of action because it directly aligns with the principles of sound underwriting practice and regulatory compliance. Underwriting authority is a critical control mechanism designed to ensure that risks are assessed and accepted within defined parameters, reflecting the insurer's risk appetite and financial capacity. By escalating, the underwriter upholds the integrity of the underwriting process, prevents potential adverse selection, and ensures that the decision is made by an individual appropriately empowered to accept the associated risk. This adheres to the fundamental principle of acting within one's delegated authority, a cornerstone of responsible financial services operations. An incorrect approach would be to unilaterally approve the policy, exceeding the established underwriting authority. This is professionally unacceptable because it violates the principle of acting within delegated authority, which is often a requirement stipulated by regulatory bodies and internal governance frameworks. Such an action could expose the insurer to risks it is not prepared to underwrite, potentially leading to financial losses and reputational damage. It also undermines the internal control structure and the authority of those who set the underwriting guidelines. Another incorrect approach would be to reject the business outright without considering any potential for negotiation or referral. While adhering to authority limits is crucial, complete rejection without exploring alternatives or seeking guidance from a more senior underwriter can lead to lost business opportunities and may not be in the best interest of the insurer if the risk could be managed or priced appropriately with the right authority. This approach fails to demonstrate a proactive and solutions-oriented mindset expected of an underwriter. A further incorrect approach would be to approve the policy by making minor, superficial adjustments to the terms that do not fundamentally alter the risk profile, but are intended to circumvent the need for escalation. This is a form of misrepresentation and a breach of ethical conduct. It attempts to create the illusion of compliance while still operating outside the spirit, if not the letter, of the underwriting authority. This undermines trust and the integrity of the underwriting process. The professional decision-making process for similar situations should involve a clear understanding of one's own underwriting authority limits. When a case falls outside these limits, the immediate and correct step is to identify the appropriate escalation path. This might involve consulting with a senior underwriter, a subject matter expert, or a designated authority holder. The decision-making framework should prioritize adherence to established guidelines and risk management principles, while also seeking to find commercially viable solutions where possible through the correct channels. Question 19. When evaluating an applicant's medical history for a life insurance policy, and the applicant's condition is not explicitly addressed in the standard underwriting guidelines, which approach best demonstrates sound underwriting practice and adherence to regulatory expectations? Option A. Approve the application with a standard rating without further investigation, assuming the condition is not severe. Option B. Consult with senior underwriting management or a medical underwriter to discuss the specific case, seek clarification on how to assess the condition, and document the rationale for any decision made. Option C. Reject the application outright due to the absence of clear guidance in the standard underwriting manual. Option D. Deviate from the guidelines based on personal intuition about the applicant's overall health and lifestyle. The correct answer is D. Deviate from the guidelines based on personal intuition about the applicant's overall health and lifestyle. Explanation. This scenario is professionally challenging because it requires the underwriter to balance the need to adhere to established underwriting guidelines with the potential for individual circumstances to warrant an exception. The core tension lies in maintaining consistency and fairness across all applications, while also recognizing that rigid adherence can sometimes lead to inequitable outcomes. Careful judgment is required to distinguish between genuine risk factors that must be addressed and situations where a deviation from standard practice might be justified and still within regulatory parameters. The correct approach involves a thorough review of the applicant's specific circumstances against the underwriting guidelines, seeking clarification from senior management or a designated underwriting committee when an exception is contemplated, and documenting the rationale for any deviation. This approach is correct because it upholds the principle of sound underwriting by ensuring that all relevant risk factors are considered. It aligns with regulatory expectations that underwriting decisions should be based on objective criteria and a consistent application of rules, while also allowing for a structured process to handle exceptions. Seeking senior approval and thorough documentation are critical for demonstrating compliance, mitigating potential future disputes, and ensuring that any deviation is well-reasoned and justifiable, thereby protecting both the insurer and the applicant. An incorrect approach that relies solely on personal judgment, without consulting established procedures or seeking appropriate authorization, fails to demonstrate due diligence. This can lead to inconsistent decision-making, potentially exposing the insurer to undue risk and violating principles of fairness and equity. Such an approach may also contravene regulatory requirements for documented underwriting processes and decision-making authority. Another incorrect approach that involves making an exception based on non-risk-related factors, such as personal rapport with the applicant or a desire to expedite the process, is ethically unsound and likely violates regulatory principles. Underwriting decisions must be based on objective risk assessment, not subjective or external influences. This can lead to adverse selection and unfair treatment of other applicants. Finally, an incorrect approach that rigidly applies the guidelines without considering any mitigating factors or the overall risk profile of the applicant, even when the guidelines might allow for discretion, can also be problematic. While adherence to guidelines is crucial, an overly rigid interpretation can lead to the rejection of otherwise acceptable risks, potentially harming the insurer's market position and failing to serve the needs of a broader customer base. The professional reasoning process should involve a systematic evaluation of the application against the guidelines, identifying any areas of concern, exploring potential mitigating factors, consulting internal policies and senior colleagues for guidance on exceptions, and meticulously documenting the final decision and its justification. Question 20. Risk assessment procedures indicate that an underwriter needs to gather detailed medical history to accurately assess an applicant's insurability for a life insurance policy. Which of the following approaches best optimizes the information gathering process while adhering to regulatory and ethical standards? Option A. Obtaining the applicant's explicit consent to request specific medical records directly from healthcare providers that are relevant to the underwriting questions posed, and supplementing with a detailed medical questionnaire completed by the applicant. Option B. Requesting a comprehensive medical report from the applicant's primary care physician, covering all medical conditions and treatments over the past 10 years, without prior specific inquiry into the applicant's medical history. Option C. Conducting a thorough review of the applicant's social media profiles and publicly available online records to infer potential health risks. Option D. Asking the applicant to provide a written statement detailing any pre-existing conditions and their current management, without requesting any supporting medical documentation. The correct answer is B. Requesting a comprehensive medical report from the applicant's primary care physician, covering all medical conditions and treatments over the past 10 years, without prior specific inquiry into the applicant's medical history. Explanation. This scenario is professionally challenging because it requires an underwriter to balance the need for comprehensive information with the ethical and regulatory obligations to protect applicant privacy and avoid unnecessary data collection. The underwriter must exercise careful judgment to ensure that the information gathered is both relevant to the risk assessment and obtained through appropriate, compliant channels. The correct approach involves a systematic and targeted information gathering process that prioritizes obtaining essential details directly from the applicant or through authorized third parties, while respecting data protection principles. This approach is right because it aligns with the core principles of underwriting, which mandate that decisions be based on accurate and relevant information. Furthermore, it adheres to regulatory frameworks that govern data privacy and fair information practices, ensuring that applicants are treated ethically and their personal information is handled responsibly. Specifically, this approach respects the principle of data minimization, collecting only what is necessary for the underwriting decision, and ensures that information is obtained with the applicant's consent or through legally permissible means. An incorrect approach that involves broadly requesting all available medical records without a specific, justifiable need for each piece of information fails to adhere to the principle of data minimization. This can lead to the collection of irrelevant or overly sensitive data, increasing the risk of privacy breaches and potentially violating data protection regulations that require data to be adequate, relevant, and not excessive. Another incorrect approach, such as relying solely on publicly available information without verifying its accuracy or completeness for underwriting purposes, is professionally unacceptable. Publicly available data may be outdated, incomplete, or inaccurate, leading to flawed risk assessments and potentially unfair underwriting decisions. This also bypasses the applicant's direct input, which is a fundamental part of the information gathering process. A further incorrect approach, such as using speculative or discriminatory questions to elicit information, is ethically and regulatorily unsound. Underwriting must be based on objective risk factors and not on assumptions or biases that could lead to unfair discrimination. This violates principles of fairness and equal treatment. Professionals should employ a decision-making framework that begins with clearly defining the underwriting criteria and the specific information required to assess those criteria. They should then identify the most direct and compliant methods for obtaining this information, prioritizing direct communication with the applicant. If third-party information is necessary, the process must involve obtaining explicit consent and adhering to all relevant data protection laws. Regular review of information gathering processes is also crucial to ensure ongoing compliance and efficiency.